Assalamualaikum warahmatullahi wabarakatuh. Let me introduce myself. My name is Aulia Nur Aziza Putri Sharif. So today I will present my paper, and the title is Macroeconomic Impacts on Profit Growth in Indonesian Islamic Banking. For the first, the introduction is in an era of increased economic volatility, macroeconomic factor such as inflation, exchange rates, and gross domestic product or GDP growth plays substantial roles in determining the profit trajectories of companies, especially those in emerging economies like Indonesia. For Islamic banks, this influence are further complicated by operational principles that differ significantly from conventional banking systems, particularly regarding interest prohibition and profit and loss sharing models. For the background, profit growth serves as a core indicator of financial health, business performance, and organizational efficiency. In Islamic banking, achieving sustained profit growth is critical for meeting operational and ethical requirements as well as for attracting both local and international investors. On the other hand, macroeconomic variables such as inflation, exchange rates, and GDP exert profound effects on corporate profitability across all sectors. However, the impacts of these factors on Islamic banking institutions remain underexplored. Inflation can reduce consumer purchasing power and raise operational costs, which may slow profit growth. Also, exchange rates also play a pivotal role, especially in import-reliant economies like Indonesia. For the GDP growth as a measure of economic health generally correlates positively with corporate profit growth as it signals rising consumer demand and a favorable business environment. For the research gap and objective, previous studies have examined the impact of macroeconomic variables on profit growth in conventional banks. The Islamic banking sector remains under research, especially in the Indonesian context. Additionally, existing literature often presents mixed findings regarding the extent and nature of this macroeconomic influence, further emphasizing the need for targeted research on Islamic banking. The study seeks to bridge this gap by focusing specifically on Islamic banks in Indonesia, exploring how inflation, exchange rates, and GDP impact their profit growth. The findings aim to clarify the unique response of Islamic banks to macroeconomic shifts, contributing to more informed financial and policy decisions. For the hypothesis, for the H1, inflation has negative effect on profit growth in Islamic banks due to its impacts on consumer purchasing power and operational costs. H2, exchange rate fluctuation influence profit growth with depreciation potentially reducing profit margins in banks with foreign exchange exposure. H3, GDP growth has a positive effect on profit growth in Islamic banks, aligning with general economic trends that link increased consumer spending with enhanced corporate profitability. For the literature review, the first inflation and Islamic bank profit growth from Ahmadi 2023, the inflation affect profit growth by altering both consumer purchasing power and the cost structure of firms. In high inflation periods, consumer spending typically declines, which can reduce demand for banking service, including financing options. The second one is exchange rates and profit growth in Islamic banking from Yulianta and Nurjaya 2021. The exchange rate fluctuation impact profit growth by altering the value of foreign denominated assets and liabilities. For Islamic banks with significant import exposure for foreign financing, currency depreciation can increase costs, thereby reducing profitability. And the third one is GDP growth and profit potential in Islamic banks from Hastuti et al. 2023. GDP growth is a widely recognized driver of corporate profitability, as it generally signals the context of Islamic banking. GDP growth can enhance profit potential by increasing demand for financing and investment products. For the methodology, in this research, employs a quantitative approach to examine the effect of macroeconomic variables specifically inflation, exchange rates, and GDP on profit growth among Islamic banks listed on the Indonesia Stock Exchange. The data for this research was sourced from the Indonesia Stock Exchange for corporate profit data and Bank Indonesia for macroeconomic indicators such as inflation, exchange rates, and GDP. For the result, diagnostic test for the best on the table, shown the Kolmogorov-Smirnov test is used to verify whether residuals are normally distributed. Variance inflation factor values for each independent variable are calculated to assess collinearity. So the conclusion is data are normally distributed and no multicollinearity and no autocorrelation. For the regression analysis test, the regression model indicates that one of the variables, inflation, exchange rate, or GDP growth, exhibit a statistically significant effect on profit growth. The constant term is also not significant, suggesting that factors other than those included in the model may influence profit growth. So the interpretation is inflation, exchange rate, and GDP growth is not significant. So the macroeconomic, for the H1, inflation has negative effect on profit growth in Islamic banks is rejected. For the H2, exchange rate fluctuation influence profit growth is rejected. And H3, GDP growth has a positive effect on profit growth in Islamic banks is rejected. The unique business model of Islamic banks may explain this result. Islamic banks are not as exposed to inflation-driven change in interest rates, which are typically adjusted to combat rising inflation. Islamic banks may have a natural buffer against inflation impact on profitability. Additionally, inflation can lead to higher costs for conventional business due to increased borrowing expense, but Islamic banks' profit-sharing approach reduces the dependence on fixed-rate financial products, thereby diminishing inflationary impacts on their cost structures. The explain for the H2, Islamic banks are less dependent on foreign denominated transactions, which may explain the absence of a significant effect. Additionally, the financing structures used by Islamic banks are less sensitive to currency fluctuation. Unlike conventional banks, which may have substantial foreign denominated debt exposure, Islamic banks rely on profit-sharing mechanisms, which offer more flexibility in adjusting to currency fluctuation. They explain for H3, however, the absence of significant impact on profit growth aligns with findings by Meliana 2020, states that Islamic banks might exhibit different response to economic cycles compared to a conventional banks. Islamic banks are structured around ethical financing and profit sharing, which can make them less sensitive to immediate economic fluctuation. And the conclusion is, in this study indicates, the first is the primary findings indicate that none of these macroeconomic variables significantly affect profit growth in the sample firms, which contrasts with traditional economic assumption that link this factor with corporate profitability. And the second is the findings have important implication for both investors and policymakers. For investor, Islamic banks in Indonesia may represent a stable investment option, especially during periods of economic volatility, as their business model provides a natural hedge against rapid macroeconomic change. And for policymakers, the study suggests that regulatory frameworks for Islamic banks should consider their unique financial structures and resilience to traditional economic indicators. And the third one is this study contributes to the existing body of knowledge by providing empirical evidence on the distinct ways Islamic banks respond to macroeconomic variables in an emerging market context. These findings highlight the need for further research comparing the response of Islamic and conventional banks to macroeconomic factors, potentially exploring sector-specific and country-specific dynamics. Future research could expand the scope by including longer time frames, incorporating additional economic indicators, or employing more complex econometric models to gain deeper insight into the mechanism driving these relationships. That's all for me. So thank you for the attention. Wassalamualaikum warahmatullahi wabarakatuh.